The retail sector is closely eyeing the CPI inflation rate in South Africa, and the Reserve Bank is coming out with its decision on local interest rates tomorrow. So let's talk now about the CPI, which was released in the last couple of hours in South Africa, with John Luce, who is the household and consumer sector strategist at FNB. 5.6% in November, John, and 5.7% in December, edging higher, so nothing to worry about, I don't think.
No, Lindsay, that slight change, 0.1 of a percentage point up, was really just a little increase in the year-on-year fuel price inflation rate, which was a bit of a base effect. So nothing much. And I think what we've seen, I think high base effects in the oil market are starting to set in, and we're starting to see slowing inflation in rand-denominated oil prices. So I think with time we should see slowing inflation rates in petrol prices too. So that area is less of a concern to me. So no, I don't think that it's necessary or essential that we should just expect CPI inflation to continue rising. I think a more likely scenario is it'll just hover around at the right here where it is now, at the upper end of the inflation target range.
Okay, well, we've got that oil price. I mean, we look at Brent crude on CNBC Africa, and you get that price, I think, during the month of December, messing around between $110 and $111 per barrel. The rand was considerably stronger than it is now. So let's say that the Brent crude price 112. 10, 112.20, something like that, and the rand now pushing 9 again. Surely, despite the high base effect, there's going to be a little bit of an impact on that 5.7% December figure we've just seen.
Well, I think the inflation rate in petrol will probably continue in some form, but the petrol price inflation rate was around about 12.4% year on year for the December CPI. I'm not convinced it'll stay at that rate. It may well come down a little, but yes, the rand is key, and the rand, obviously, we know the rand is somewhat volatile and unpredictable. The rand will be, I think, key to the performance of the petrol price, probably more so than the oil prices themselves, which are just stuck around there at high levels, but not really inflating significantly.
Given this 5.7% we've just seen, I mean, I should have asked you this right at the end of the interview, but I've got to bring it in now. Do you think Jill Marcus and her team will be looking at $8.94 rand and 5.7% inflation, just coming towards that 6% top level of her band? And she might be saying, well, we're not going to increase rates now. We're certainly not going to cut, but the next move might be to the upside should we start to break that 6% level.
Yeah, Lindsay, I think certainly the rate where it is now militates against a cut tomorrow, or possibly at the next meeting as well. We'd have to see some meaningful decline in CPI inflation. But you know, I don't think we should just expect it. It has been going slightly up recently, but there's global factors that need to play a role.
What about the food side of things? We've spoken about the oil price, we've spoken about the rand. Is food starting to become a problem, John?
Well, it has become I think it has been troublesome over the past decade. It's had some big surges for various reasons, and always subject to global weather patterns, and the prices are to a large extent globalized, as I understand. So recently we did see a surge in food price inflation. We saw it more in the PPI than in the CPI, but a bit in the CPI as well. And that's reportedly a lot to do with the US drought. It hasn't seemed to surge like it did back in 2008, which is good news, I guess, but the food index being so big and being above the overall CPI inflation rate is the biggest single contributor to the CPI inflation rate at the moment. So it's somewhat troublesome. It's troublesome more so too because it affects the poor more, because it's a bigger weighting in their expenditure basket, and thus the poor, the lower income groups, have higher CPI inflation rates than the high income group, which is not good from a social unrest point of view either. So food is troublesome at the moment, but that's I'm not an agricultural expert, but these droughts do come and go, and food prices do fluctuate quite significantly.
Yeah, we've talked about things now that we really can't control, i.e. the dollar-rand exchange rate. We've talked about the food prices, which are, governed, I suppose, by exchanges like the Chicago Board of Trade, and we've also spoken about the oil price, which we've got absolutely nothing to do with. Something we have got something to do with in South Africa is money supply and unsecured lending and things like that. Given what you've seen in 2012, and given the comments from people in the lending industry about reining in people's borrowing, do you think maybe that will put a brake on CPI?
Well, I hope so. I think certainly if one looks at non-mortgage related household credit, if you take that, exclude the mortgage lending, which is going along at a pedestrian pace, the rest is growing at somewhere around about 25%. So it's a cause for concern. In a very slow economic growth environment, 25% for more consumer related credit is far too high. And I think, yes, what we will see this year is some slowing in that growth rate. It's to be encouraged, I believe, and as a result, yes, you could see some dampening of inflationary pressures, but not too much, because remember, a lot of the consumer goods, the more retail, the consumer goods aren't that, the price growth isn't that rapid. In the areas of clothing, textiles, footwear, household appliances, those have been some of the low inflation rates. The higher inflation rates have been often the ones outside our control, the food, the petrol, and then locally the electricity tariffs, the water tariffs and municipal rates. Those are some of the troublesome ones. Those are monopolistic environments, the ones I've just mentioned, the rates and utilities, and they're not going to respond necessarily to a dampening in demand for those products. So we've got some structural matters to deal with, or some certain inflation rates that are quite rigid. Slower private sector or household sector credit, I think, is to be welcomed. I believe it should come about during this year, but I'm not convinced it'll do too much to dampen the overall inflationary pressures.
Okay, so what you're saying basically is that the things that are out of our control, the things that are governed by government, i.e. electricity prices going up, the dollar-rand exchange rate, all the things we've mentioned are going to overwhelm the slight dampening or potential dampening effects of lower demand from the consumer. In that light, 5.7% in December, what about January? Do you think we're going to push towards that 6%?
No, I don't. I suspect one may see a slight decline in year-on-year petrol price inflation. I don't think we'll see a meaningful move from where we are now. I think, Lindsay, that in the coming few months we'll probably see CPI inflation rate hovering at about around these levels.
And from a policy point of view, when Jill Marcus stands up at the podium tomorrow at 3 o'clock in the afternoon, she's going to say all the things that you've just said and leave rates unchanged, of course. If it does start to push towards the end of the year above that 6% level, or even starts to nudge it, do you think there's any temptation for there to be any change from the flat line that we've had on interest rates in South Africa for a little while now?
Lindsay, I think it's going to depend what pushes it up. We saw a year or so ago a surge in food price inflation, and we did reach the 6% target. But because it was one of those uncontrollable factors, the Reserve Bank was inclined to leave rates constant. If it's wage inflation driving unit labour costs up and it's more homegrown inflationary pressures, then I think the time would come for interest rate hiking. But I'm not convinced that homegrown inflation or our economy can drive significant inflation in a time when we've got a fairly weak economic environment. I think that's probably still some way off.